All right, so what we want to do today, I want to do a little bit of real quick introduction on some stuff that is in the notes that won't be on the video for next week. And then I want to get into, definitely get into paper one, because paper one, so you have two things to do the next few weeks. The number one thing is paper one, but you can't start on paper one really until next Friday. But you can read ahead, and I'll show you some stuff that you can read ahead on. You could actually start creating some charts, and I'll show you what you can do. Remember, you know, getting extra bonus points, especially with me. You know, do beyond what's just specifically asked in the paper, and try to find some ways that you can do some stuff that's pretty good analysis. You're trying to make your boss look like a genius, so what can you do beyond just what's in the assignment? We'll go through the assignment. So let me see, this sharing the screen thing is still kind of tough for me because it's, I don't know if you see what I get when I try to share the screen, but everything looks the same. So let me see if I can find it. There it is. And some of them don't even show up. Nope, that's not it. Boy. All right, I've got it. All right, let's, okay, here, we'll do this. All right, so in the class notes, hopefully y'all can see this. I might go on the screen show just so I can keep this going. So, first of all is web pages. So you should probably have some web pages that you go to all the time. These are really basic ones. I'll show you a whole lot more. FinViz. I don't know how many of you use FinViz. I don't know why it's a V instead of a B, but FinViz, I'll show you it today. It's a really good one to use for paper one. I like FinViz a lot, especially because it's a futures, it provides futures information, and so you get to look at markets before they're open, which I tell you what, in 2008, there were times I was getting up at 2 a.m. to see what was happening in Japan because I was so stressed out of the market back then. And FinViz was a good place to go. Obviously, Yahoo Finance, we'll use a lot of Yahoo Finance. I know Yahoo's not much of a company anymore other than their holdings of some of their subsidiaries, but they do provide a lot of really, really good information. The Federal Reserve, I'll show you them today, especially the St. Louis Fed. I have been a big fan of the Fred add-in, which is an Excel add-in. I've gotten to the point now I don't use that anymore, and I'll show you what I use instead. If you've ever tried to do the Fred add-in, I'm finding it a little bit cumbersome to use these days, and so I'll show you how I do it differently. William Sharp, you know, the father of modern finance and Nobel Prize winner, he has a lot of his articles out there. I'll be referencing some of his articles. I have not been on Bloomberg.com in a while. Bloomberg, don't get confused between the Bloomberg machines and the FSC and Bloomberg.com. They're two radically different things. So Bloomberg.com is just their web page. I think the reason I've stopped using Bloomberg is I think they require registration now, but I haven't been in there a while, but you might try it. They have been a really good source in the past for paper one, but I think now because they've changed their website, they're not as valuable as they have been. And there's a lot of other places. So I'll show you some today, but and I'll show you also the kind of data you should be looking at least once a week. You know, obviously when you go into an interview, you got to know where the S&P is. I know everybody knows where the Dow Jones is, but when you go into finance, they don't follow the Dow Jones, they follow the S&P 500. Got to know where the 10-year Treasury is. You've got to know what the Fed's doing, where the Fed rate is. Right now it's easy because it's 0 to 25. Pretty easy to remember, but no, there's certain numbers as a finance major, you just know those numbers. So have websites, have things data that you bring in all the time. I'm going to show you some really cool things you should do before your first interviews today. I do have a book reading list. I'll show it to you. If you've already, I think most of you have already taken stats, so I wish I could have caught you earlier. But if you haven't taken stats, or if you can take more advanced stats, I highly recommend these two books. When I took statistics, I was at UT Austin. I was an accounting major, so you know I was like, take stats, get it out of the way, forget about it. Then didn't realize it was the most important class I took in undergraduate. And I think the problem with statistics is they usually have it taught from the math department. I wish they would teach stats as a business course in the business department. I didn't realize how important it was, and so much of statistics from the math standpoint is so different than in business. And what these two books do is they take statistics and they apply it in ways you can see how valuable it is. You can actually see the application of it. So they're good books. You can get them on Amazon, or you can get them on Audible or wherever. Listen to them while you're running or exercising or whatever, or in your car. Really good books. So I highly recommend those. Be great if you have friends that haven't started stats yet. I would tell them, read these books before you start stats, because you will find really opens up that class. Some of you are probably thinking, I don't remember anything from my stats class. And yeah, that's bad, because it is the single most important class you take undergraduate. So you might need to go back and refresh on that. And that gets down to one of my sayings. I don't know who said this. I forget who said it, but practice doesn't make perfect. Only perfect practice makes perfect. I heard it just this last week in a podcast. You've got to be doing the right kinds of things. It's looking at markets. It's reading articles. It's going to websites like hedge funds and investment firms, reading their articles. My favorite economist is Lacey Hunt, so I like to go to Hoisington Asset Management, go to their website and read his quarterly newsletter. It's really, really good. GMO.com, there's all of them. AQR, Bridgewater, there's so many places. It's almost too much. What you've got to do is find what you like to read, what really gets you excited, the best speakers, the best writers, and do that every day. What is not perfect practice is reading textbooks. So as you get further along in your college career, you do less textbooks and more articles and podcasts. It's more application. So the textbooks give you the theory, and now you got to take the theory and you got to actually apply it. So right now you're kind of in between of a lot of good textbooks, but also a lot of good articles. As you get further along, especially get into your career, it's extremely rare that you will reference a textbook once you graduate. You're going to be reading articles. So go find where they are. In the FSC, I put all my old financial analyst journals in there. There's just hundreds of them. You're welcome to check those out for free if you can ever open up that room. So, you know, there's a lot of great stuff that's free. So start doing that. You should be reading, besides textbooks, you should probably be reading 10 to 20 hours a week. But that 10 to 20 hours a week can include podcasts and those kind of things. Let me show you my my book reading list. This is out on Blackboard. I think I put it, it's the first file under miscellaneous files. And it starts, someone's got noise. Someone needs to mute. All right, so I'll just scream. Can y'all hear me? Hopefully. So I start off this with some podcasts, and the podcasts, I love Masters in Business. I like Invest Like the Best. They're both excellent. In fact, I like Invest Like the Best better. I like Econ Talk. It's a little bit esoteric, but really good stuff. I read The Economist cover to cover every single week. So yeah, there's someone out there. Everybody check their check and make sure you're on mute if you got noise behind you. It won't show me who it is. Y'all don't know who it is. All right, I wish it would tell me. All right, sorry guys. All right, I've got a different group of you staring at me, so that's okay. All right, so there's some good ones. I don't know if y'all read The Economist, but boy, I would put The Economist on your list. Here's something by William Sharp. Cliff Asness is one of my favorites. I would definitely go out there. And anytime, he's actually won a lot of awards for his articles. He is an extremely advanced hedge fund manager. His math skills are pretty strong, but he can write for the common person. So you can read his stuff. I'm a huge fan of Doug Hubbard. Oh my word, if you take my risk management class, we'll be watching some of his videos. He's not a finance person, but boy, he knows more about finance than most finance people do. MIT has a course. It's a graduate level course online. New York Stern School as well has class. If you want to take those classes, I've done some of those classes and took notes as I went. So if you want to do any of those, yeah, Damodaran, he has 2 classes online from New York Stern. I watched both of them and took notes all the way throughout. So if you don't want to watch his classes, you just want the notes from that class, you're certainly welcome to them. They're graduate level classes, so they're a little advanced. PBS Frontline has a really scary YouTube showing how unethical our industry is. These two podcasts from Demodaran are excellent. They're actually YouTube videos. I absolutely recommend you watch these. They will help you dramatically in interviews. Books on behavioral finance are really good. Everybody needs to read these first two. Boy, Annie Duke's become my favorite author. She is so excellent, and she's on podcasts, and she's really, really good speaker. I wish we could afford to bring her down to UTSA and speak. But she's on podcasts, she's on YouTube, she speaks at conferences now. She's actually got a new book coming out. I'm kind of curious to see. But Kahneman is really big on that, and there's some others out there that are really, really good. Bernstein, I actually met him. I have one of his books, Against the Gods, with his autograph. Excellent, excellent writer. His Capital Ideas, it's a little dated now, but excellent, excellent book, because he goes through the history of finance from day one, so you understand why the 50s had to happen before the 60s as far as finance. What did we learn in the 60s that allowed us to do Black-Scholes in the 70s? What happened with Markowitz and the Efficient Frontier and CAPM, and he goes through it, and he's a very good writer. He's very brilliant. He was a very brilliant man. He's passed away, unfortunately. But he had a way of writing very humorously, very understandably. And you see all the rest of them. Obviously, Taleb. I hope y'all have been reading Taleb. If you haven't read Taleb, I would actually recommend you start with Fooled by Randomness. I actually like that better than Black Swan. Taleb says Anti-Fragile is his most important book. I thought it was his worst book, but anyway. Have y'all read Nassim Taleb? This is the time. Get ahead of the competition, because a lot of people you're interviewing with, they know Taleb backwards and forward. So that would help you a lot. You can also, up here I mentioned Kahneman's Thinking Fast and Slow. There's actually a YouTube video that's really good that shows Taleb being interviewed by Kahneman. And it's really fascinating. Taleb looks pretty bad in the interview, but it's really fascinating. Economic theory, you can see my biases here. Yeah, I am somewhat on the libertarian side on this, but that's fine. I love Milton Friedman. He writes. One thing I like about him is he's very respectful to the people he disagrees with, unlike some of the other writers out there. Obviously, Whelan is extremely libertarian, but that's fine. Read these guys. There's Doug Hubbard again. Decision making. We'll talk about some of these books in the class, like Why Nations Failed. Some of these I'll mention in class. And these last one, boy, I wish I had read these last three books when I was your age. They didn't exist when I was your age. Peak tells you how to become successful at a technical enterprise like finance. Deep Work tells you how to get ahead of the competition in a distracted world. You might not like his answers, but you'll do a lot better in your career if you do listen to him. Range is shows how becoming a generalist helps you get ahead in the world. So Peak and Range are the two opposites. But that's my reading list. I had more things to it, but get out of the habit of just reading textbooks. Start reading other stuff. I don't know how many of y'all listen to finance podcasts every week, but if you're not, start yesterday, because you're about 3 years behind. So start doing that. And what that does, remember I talked last class, finance right now is a second language. And so you don't sound like a native speaker. If you listen to these podcasts, you start sounding like an investment professional. You start using the jargon correctly and all that kind of stuff. So, all right. Questions up to there? Everybody still with me? All right, let's jump back to the, just go on mute and come back in. All right, so a lot of things you can read. I'm not going to do my Essence of Finance presentation. I normally do it in this class, but I want to get right to the paper one and to the exam one pretty quickly. But if I had to summarize my Essence of Finance, is what I call the value creation process. Those that took my 3013 class, I did show them this presentation, all of it. It's a pretty lengthy presentation, but what do you do in finance? So if you're a finance major, what are you going to be doing the next 50 years of your life? Maybe 40 years. If you retire, or, you know, I retired at 45, 46, so maybe 25 years. We forecast, we assess risk to get discount rates, we do discounted cash flows, we compare our valuation to the market, and we make a decision. I mean, that's it. That's what you're going to be doing next 50 years of your life. I teach a security analysis class. Most of those students are seniors about to graduate. And it really bothers me that most of them, probably 90% of the class, have never done a forecast undergraduate. That's one of the reasons they argue that you should take the modeling class, the financial modeling class. So if you've never done a forecast, you know, it's a pretty critical thing to know how to do. You get a lot of this number two in your classes. Capital asset pricing model, weighted average cost of capital. We do number two all the time, but we hardly ever teach students how to do forecasting. And it's really critical skill to have. The number 3, 4, and 5 are the easy ones. This kind of cash flows, you can do that in your sleep. We'll do a few of those in this class. And then knowing where the market prices are to compare them to your valuation, that's pretty easy to do as well. For stocks, for bonds is a little more difficult. And then finally, you've got to make a decision. So this is our class. This is what we will be doing, trying to figure out what decisions we want to do in finance based on our assessment of the future and our assessment of risk, and make decisions. What's the essence of accounting? I think we had a few accounting majors. The nice thing about the essence of accounting is that the accountants tell us what it is. And sorry, accounting majors, but according to the accountants, and this is not according to Professor Sweet, according to the accountants, accounting works for finance. So remember that. So if you're an accounting finance major, you start off in accounting, then you be the finance so you can be the boss. How do I say that? Because accounting says the reason we're producing these accounting statements is to be useful for investment and credit decisions. That's finance. Look at that second one. Remember my first step on the valuation process is forecast future cash flows. Guess what the accountants say? Accounting is supposed to help you forecast future cash flows. And then accounting gets you balance sheets, income statements, and cash flow statements. So, so just remember that. When I was at UTSA, the auditors used to bug the life out of me. And I kept reminding them of this. You know, accounting is supposed to support, this is the purpose of accounting. I would actually carry this around in my wallet. And when I had an auditor, was asking me to do really stupid things. I would say, how is that going to be helpful for an investment or credit decision maker? How is that going to help someone forecast future cash flows? And the auditors would just say, leave us alone. We're tired of being sued. We just want to do whatever's conservative. But the nice thing was they got so irritated with me, they stopped coming to me. So, and that's good. If auditors leave you alone, that's a good thing. And so, but if you're a finance major, I would print this out and carry it around in your wallet. And don't overuse it, especially early in your career. It might get you fired because accountants have a lot of power when you first start out. Their power gets weaker as you move up in finance. But do remember this. This is what GAAP accounting is supposed to accomplish. All right, so let's talk paper one, unless someone has some questions. So make sure you're taking good notes. You should always, when you're around me, you should always make it look like you have something to write with, or you're typing notes. Don't just stare at me because that makes me nervous. Or let me find the paper one description. You have this on Blackboard. All right, I wish the photos would switch around to different students because I'll have to switch around. So, all right. Should I tell you which students I can see or not? Can y'all tell? I can see Joe right now. He's the only one I can see. So sorry, Joe. All right. So this is your paper one. This is an extremely real life paper. There's a good chance your first boss would ask you to do this. So the single most important economic release by far is the jobs report. It comes out usually the first Friday of every month. You do not want to interview for a job on the first Friday of the month where you haven't read this report in detail. So it's an extremely important report. Finance always looks out for it. So your report will come out next Friday, not this week, but next week. So this is due October 2nd. This report will come out next Friday, September 5th. So you have about a month. Now, think about what I'm asking you to do. In real life, your boss would ask you to do this and have it on her desk by, say, 9:30. So she'll give you about an hour, not even that. I'm giving you almost a month, all right? So I'm giving you a month to do something you would normally do in an hour, because this may be the first time you've done something like this. So I want you to get good practice with it. So I want you to get in the habit. Now, if all you do is this paper and you never go back to this employment report ever again, and then I've wasted my time, you've wasted your time. My goal in this is to get you in the habit of watching economic reports and seeing how the market reacts. That's what you do as a finance person all the time. It's part of your job. So start looking out for these and strengthen your understanding of how markets respond to these releases. So your boss needs a summary of the September 4th payroll, employment, and unemployment rate. Put in your notes right now, there's two things here. There's the jobs report, that's one thing, and the unemployment rate. Those are two different things. And they actually can contradict each other. It's very possible for them to contradict each other. The jobs report is a survey of corporations, asking them how many people they're hiring. It tends to be skewed toward larger corporations, and so it's possible it can be a little distorted. The market tends to focus more on that report than on the unemployment rate. So CNN and Fox News, they focus on the unemployment rate, but the markets tend to focus on the jobs report. Not always. There's times where they switch around depending on what the markets are doing. The unemployment rate is, you may have heard it as the household survey. It's actually a survey of households. And several years ago, probably it's been 6 or 7 years ago, this entity called me and said, we want to make you part of this survey. Do you want to do it? I said, you betcha. I was pretty excited about that. I wanted to see how it actually worked. And it was very interesting. They interviewed me for about 4 years in a row. Every month, they asked some really personal questions. The last time they interviewed me, I was kind of like, are you still working for them, or is this like some kind of sham you got set up? The questions they were asking, but it was interesting. They would ask me, did you work last week? Then they'd ask me, if you didn't work last week, did you want to work last week? And so during the summer, they'd ask me, did you work last week? Well, I'm a college professor. I'm off in the summers. I said, well, I didn't work last week. They asked, did you want to work last week? Well, I said, no, I don't know. I might have messed up the unemployment rate that month because I didn't know how to answer that question. But it's a survey, and they are quite tenacious on their survey. There was an article came out a few years ago that one of the interviewers was just making stuff up and turning it in. I think that's pretty rare. If I didn't answer the phone or come to the door, they were adamant I had to answer the survey. They did not give up on me. They kept trying over and over. They'd be sitting waiting at my door when I got back from my bike ride. So I think most of the people they have doing this are quite serious about it. And I think these numbers are pretty trustworthy. So those are the two numbers you're looking at, all right? So what you're going to do is these three things, or really more than that, but these three things. First, you have to tell me, how did the release come out versus what was expected? So that means, first of all, you have to figure out what was expected. I'll show you that. What did the markets expect? And then how did it come in? And then you need to find some articles, and it's really easy to find articles. You can go to Yahoo Finance, Bloomberg. There's a lot of places you can go. You can go to YouTube, and you'll find videos talking about the unemployment report. So what does this mean for the economy? Now, this is real important right now because you have a unique situation that an election is coming up. So obviously, President Trump wants a really good employment report. He wants to show that the economy is coming back. The last couple of employment reports have been pretty positive. What's a little bit frightening for Trump is that the jobless claims that come out weekly, they were getting better and better and better, and then suddenly last week they got worse again. So people are worried that because y'all have heard about the furloughs and the $600 unemployment, all these things you'll be reading about. There's some people that are worried that the government support has run out, and that we're going to see another negative impact on the jobs reports. Maybe not this report for August, but maybe for September. It could be the worst case scenario for President Trump in the election. But that's what you're looking at. So you can probably guess the two things you'll absolutely be talking about in your paper, I would think. I mean, think about it from your boss's standpoint. But obviously, COVID-19 and the pandemic and what impact that's having, and including government support, and what the government's doing. You know, Congress is struggling. So that should be an obvious part of your paper. And then the election. What does this mean for the election? Remember, I told you last class, do not make this a political paper. So don't say, wow, I hope Biden wins, I hope Trump wins, or whatever. Keep this objective. Now, you can say if Biden wins, he's maybe going to increase corporate taxes, and that could be bad for the stock market. But keep it objective. Make sure you have some basis for that. Don't be bad-mouthing. Your boss might be the third nephew of a third cousin of Biden, or who knows what. So just keep it as objective as possible. You're better not to put that kind of thing in a paper anyway. To say you don't want to say we're better off if so-and-so wins or so-and-so wins. So and those type of things, if you're going to hit something somewhat political, you're better off quoting someone from an article than you are actually just putting your own personal opinion. Because bosses can be a little bit scary in their reaction. All right, so those are the first two things. Let me show you something on that here real quickly. Let me see if I can. All right. Okay, so there's Yahoo Finance. I'll come back to that, but so nope, that's not it. All right. So one of the things, MarketWatch is a good place to go. MarketWatch has an economic calendar. You can just Google economic calendar. I'll give you some links in the paper description. But here is here's their economic calendar for next week, next Friday, September 4th. They don't have a forecast yet. Pretty soon, in the next few days, they will have a forecast. And you can see there's two reports. This is the jobs report, non-farm payrolls. We added 1.76 million jobs last month. That's just an incredible number. Why? Well, because we lost 30 million jobs right before that, right? Because of COVID-19. The unemployment rate, it actually dropped quite a bit. It got up to 11%. There were economists saying because of COVID-19, our unemployment rate would hit 20%. Looks like it may not do that. It went up to 11, it's dropped back down to 10. And then hourly earnings, and there's other things. You'll see all the data when you get into it. So eventually you'll have a forecast here. And then when it's reported, you'll be able to click on it, and especially MarketWatch and some of the other calendars, they'll give you a really good discussion that can help you quite a bit. Now here what I've done in this web page. This is from investing.com. They allow you to go back to the prior month. So here's August 7th. They have a lot of stuff in theirs, but here's the U.S. So in the U.S., let's see, non-farm payrolls. So the market was expecting 1.6 million, and we actually produced 1.7 million jobs. The previous month, I think, was actually a record. We added 4.8 million jobs. Pretty amazing. So non-farm payroll is there. You can click on that and get some data on that if you like. Notice two below that you have private non-farm payrolls. So non-farm payrolls includes government jobs. Private is an important number as well, so you may look at both of them. Especially right now, governments are actually cutting back on employees. And so it's possible the private may be an important number. The participation rate's extremely important. There are other employment rates that you can look at, but a lot of data here, and you can, anything that comes out on this Friday, you know, average hourly earnings is important. Are we seeing inflation in the numbers or not? How many hours are being worked? So there's a lot of stuff here. Just stick with the U.S. You don't need to go to Canada, but stick with the U.S. So you have plenty of stuff to work with. All right, any questions on this? You'll have to, I'll send you some stuff by internet through email next Friday. I'll collect a lot of this stuff and give you some links that you can go to, but you need to find your own articles. And the best time to do that is next Friday, because next Friday is when everybody's going to be writing them. If you wait till Sunday or Monday or Tuesday, you'll have to search much harder because the articles are going to be much further. And I tell you, you really need to look at it right at 8:39, 9:30. Most of the articles are written right when the numbers come out. Throughout the day, you can find other things. You might go on YouTube and find some interviews. Since we don't have access to Bloomberg, that's somewhat unfortunate, but Bloomberg has a lot of articles and a lot of interviews, actual live interviews that they do. So if you might want to go to the John Peace Library and go to their Bloomberg machine and see what you can find about the economic outlook on that Friday. There's plenty of places that you can go. Let me show you something else you can do. So if you just type unemployment rate data and the Fed, the St. Louis Fed comes up, and if you click on that, they bring up all kinds of charts. Here's the unemployment rate. You can see what happened here in the US when the unemployment rate jumped up so dramatically, even more than what we saw in 2008. Pretty amazing. And then it dropped back down really, really fast. So there's economists saying we're going to go to 20-something%, but we dropped back down. But you see this button right here on the right that you can download this data. So some of you may want to start looking at these and start thinking about charts that you can put into your paper to make it really, really, really strong. You can edit the graph and do different types of data that you want to bring in. That doesn't really make sense for the unemployment rate, but it does make sense for some of the other stuff. So I actually prefer this if you want to do some good charts. Just type in what you're looking at. So another one is the participation rate. If you do that, labor participation rate, and you click on that, you'll see where the labor participation rate is and how much it has come down in the US over the last several years. It went up dramatically in the 70s. I don't know if anyone can guess why that's the case. Who joined the workforce in the 70s? Y'all weren't alive in the 70s.
Women.
Women, yeah. So women join the workforce and our job participation rate jumps up dramatically, gets up in the high 60s. And since then, who's coming out of the workforce? It's middle-aged men that are unemployed at home playing video games, right? We've automated, with globalization, we've gone overseas. A lot of those $50 an hour blue-collar jobs have disappeared. And so, yeah, we're seeing a really big drop. And then you see what happened with, you'll notice, and that's why I think this pandemic is so big, all of these economic numbers are absolutely going off the charts because of what happened this March. Let me just give you an example. The jobless claims number, the record high jobless claim number that we've ever seen in the United States. How many people have applied for unemployment in a week? The record before this year was about 700,000 in a week. We hit several million the first week of COVID-19. We've never seen numbers like this. The worst our economy has ever dropped before is about 10% in a quarter. It dropped 33% in the second quarter. So numbers are just off the chart, and you really notice it, don't you? Man, just look how much that stands out there on the side. So you have a lot to work with. Last semester when I did this paper, it was such a horrible job report. It was so boring. Nothing exciting happened. I'm not glad COVID-19 happened, but it will probably give you a much more interesting job report to look at. So you can dump this data in, and you can do all kinds of information. The other thing you can do, I don't know how many of y'all use Statista, but Statista, you can just type in, it's just statista.com. You can just type unemployment and all kinds of things come up. So remember, your job is to make your boss look like a genius. Find something she's never thought of before that can really add some color to the unemployment report and explain. Maybe you'll find something that explains why is unemployment so bad right now, and yet the stock markets are hitting new record highs. How do you reconcile those two? You may find something that will help you. So you've got plenty of resources out there to help you. The Federal Reserve, the St. Louis Fed, Statista, you have these economic calendars, you have all kinds of things that you can reference that can really, really help you find data, find insights, find ways to talk about these markets. All right, so any questions on those first 2 points? I meant to show you the click down. Well, let me go back, sorry. Let me go back to that. I didn't mean to click off there. So if you go to this one right, not that one, this one right here, let me do the jobless non-farm payrolls right here. If you click on it, you will get a report. I do not like investing.com's report, but if you do Market Watch, or you do the one I have linked in the notes, they have a much better discussion of this. But you can click on them and get a good discussion. They'll show you some stuff. You can definitely see some of these. You might actually create a chart off of them. That's not a very exciting chart, other than to show you how off the charts we were. I mean, look at that. We lost 2 million jobs in 1 month. And then we had that record high. We added 4.8 million jobs in 1 month. Just crazy, crazy numbers. I've never seen this in my entire career. This doesn't go back. You know, if you do the max, you'll still notice. See how 2020 just goes off the charts. There's nothing else in the ballpark. So you're living through some pretty interesting times. So find some charts like that that really stand out and are shocking, and they really bring up what's going on in this current market. All right. All right. Questions on the first 2 points. So you need to talk about what the market expected, or what people were expecting and how it came out, and what does that mean for the economy. And you have dozens of things you can draw on to build that part of it. Y'all feel comfortable with that? So the goal is that you want your paper to be the example paper for next semester. So find some way to really get into this. All right, I heard someone speaking. Is there a question? No? All right, so let's go to the next section, which is the market reaction. All right, so you've talked about the economy. You talked about the release, what it means for the economy. Now you want to talk about how markets react. And here I have 2 things I require. The S&P 500 for the stock market and the 10-year Treasury. Those are the 2 things I require you to talk about. So you want to somehow talk about what you expect. Now some students do it in order, and that really doesn't make sense. So you can talk this first and second thing together. So you might say, hey, we had a really strong employment report, so I would have expected the stock market to rally, but in fact it actually sold off 1% or something like that. Or we had a weak unemployment report, I would have expected stocks to sell off, and sure enough, they sold off 0.5%. All right, so those 2 things can be covered in 1 sentence. You don't have to write a paragraph on what you expect and a paragraph on what they did. And then you have to talk, was it rational? If the market sells off, was that rational, or did it sell off too much, or should have gone up? Were there other things going on that Friday that was influencing the market beyond maybe President Trump said something, or maybe something came out on the election, or maybe they just found the vaccine for COVID-19. Obviously, that's going to make markets rally dramatically, even if we have a bad employment report. So there can be other things going on, and that's what you have to look at. Your boss didn't ask you to talk about what's going on with the election or what's going on with COVID. She asked you to talk about the employment report. But obviously, if there's other big news that morning, you would want to put that into your paper. Otherwise, your boss can say, well, why didn't you put that in there? That was pretty obvious to do. And so by the market, you want the S&P 500 and you want the 10-year Treasury. We're going to talk a little bit about the 10-year Treasury because I want you to get that right. And then about 10% of the paper is other. Other can be all kinds of things. You can look at other markets. It can be things like gold. How's gold doing? What's the US dollar doing? What's the VIX index doing? I'll show you the VIX index here. What are spreads doing? What are small company stocks doing? What's the European markets doing? How do they react? You know, there's so many things you can do. So find something else to talk about. It can be other economic data. So earlier in the week, the ISM would have come out on that Wednesday, and you don't want to talk about the ISM in your paper and without any explanation, but you might want to tell your boss, you know, to give you a little bit more, a higher level discussion of what's going on this week. 2 days earlier, the ISM came out and it was very positive. The ISM is another big report that can move markets. You might talk about jobless claims on that Thursday if it was a big number. Don't throw stuff in just to throw it in. Those find stuff that really is moving markets. And the way you'll figure that out is by reading articles. You'll read articles and they'll mention these important things. And so you need to find those things that people are talking about that are, and the obvious things. Make sure you catch the obvious things. So let me flip over. So 10% is on other things. You'll see that. So and it doesn't mean one other thing. If you do one other thing that's really weak, doesn't count. You could add one other thing where you talk about it really well and in depth. That can count. That gets you your 10%. You could do 3 other items, and they're all discussed very weakly and very high level, and that might not give you full credit. So it's not just discussing something else, but it's finding something meaty that's important. If the U.S. dollar didn't move at all, there's no reason to talk about the U.S. dollar. All right, so let me show you. So these are markets today. So what is the S&P 500 doing? So write this down. If you're not writing, write right now, because you've got to get this right. I've got to get you using the right terminology as early as possible so that if you get interviewed, you can say it just like they expect you to say it. So let me give you the nomenclature. This is the S&P. At the time I did this, it's actually up more now than when I did this at like 1 o'clock. So this is how you would say it. The S&P is up 0.2%, or 6.8 points. Let me say it again. The S&P is up 0.2%, or 6.8 points. Did y'all get that? Do I need to say it again? I'll do it one more time. The S&P 500 is up 0.2%, or 6.8 points. Don't say basis points. This is not basis points. This is points. We're going to use basis points with the 10-year Treasury, but this is points. All right, let me test it. Let me find someone randomly. Are you ready for this? Any volunteers? Let's see who's paying attention here. Nicholas, you want to try it? Are you there, Nicholas?
I can do it.
Hello. Yes, sir.
Who is this? Is that Nicholas?
Yes, sir.
All right, Nicholas, can you tell us what the Dow 30 is doing today?
It would be up 0.7% and up by 197.62 points.
Great, got it. Anybody else want to try NASDAQ? Any volunteers?
Can I try?
Okay, who's this?
Jose?
Okay, Jose.
Yeah, NASDAQ is down by 0.35% and down by 40.33 points.
All right, okay, so you got it. Now, if this were next Friday, you'd have to explain why is the S&P up, but NASDAQ is down. NASDAQ is the tech stocks. Is Apple down? Is someone in the tech industry down today? Russell 2000, that's small companies. Why are small companies down a little bit when the S&P 500 big companies and the Dow big companies are up? All right. Same thing with oil, but oil is a little bit different. Oil, you would say oil is, if you talk about oil, you don't have to talk about oil, but oil is not down points, it's down dollars and cents. So oil is down 1.54%, or 67 cents. Gold is down 1.13%, or $22. Okay, for stock markets, use the word points. For commodities, you talk in dollars and cents. They're down, silver is down 1.73%, or 47 cents. Okay, now let's do the hard one. Y'all ready for that, or y'all have questions on that? All right, not hearing anyone. Now let's do 10-year treasuries. We got about 25, 30 minutes here. Let's get Treasury. This is the hard one. This is the most points missed on the first paper. All right. First of all, ignore that 6.69%. You will never use that number. Throw it out entirely. Ignore it. Also ignore that it's in green. The S&P was in green because it's up. The NASDAQ was in red because it's down. The 10-year Treasury bond is not up today. It is actually down today. So how do we get this? All right. First of all, the 0.733, if I had seen that when I graduated from college, I would have no idea what that meant because the 10-year Treasury was 13, 14% when I was in college. And I would have thought, does that mean 73%? What does that mean? So it's a little tough to me for someone 20, 30 years ago to understand what a 0.73%, but this is 0.73%. It's less than 1%. What is it doing today versus yesterday? This 0.046, write this down, that 0.046 is 4.6 basis points. The S&P 500 is 6.8 points. It's up 6.8 points. The 10-year Treasury yield, hear that word I just added, yield. The 10-year Treasury bond yield is up 4.6 basis points. All right, I'll say it one more time. Make sure you have it. The 10-year Treasury bond yield is up 4.6 basis points. What's the 10-year Treasury bond price doing? Well, you know from 3013 that when interest rates are up, bond prices are down. So you might write a sentence like this. 10-year Treasury sold off today as the 10-year bond yield was up 4.6 basis points. All right, let me say it again. You might have exactly a sentence like this in your paper. The 10-year bond sold off today as 10-year bond yields were up 4.6 basis points. All right, let's test it. I'm going to test some of y'all. You're probably going to get this wrong the first try. So I don't know if we have someone who's got the guts to try it. But here we have March 2nd. I picked some really, we saw some stuff this year we've never seen before. Just to tell you, the 10-year Treasury has never been below 1% until this year. In 250 years of 10-year Treasury yields, it has never once in its entire history fell below 1% until 2020. Even in 2008, in the middle of a financial crisis, the 10-year Treasury did not fall below 1%. So we're at the lowest we've ever seen. Not only that, but here's the last time it was above 1%. Look how fast it fell, and it fell to 0.5%, the lowest level of the 10-year Treasury in its entire history. You might just memorize that the lowest the 10-year Treasury has ever been in its history is 0.5%, unless it falls lower in this crisis. So I need a volunteer, or I'll call on someone. What did the 10-year Treasury do on March 3rd? Any volunteers? Maybe I'll do the first one. I'll do the first one for you, okay? So on March 2nd is 1.088%. On March 3rd is 1.01%. So it fell how much? 7.8. 7.8 what? 7.8 basis points. Now remember, 1% is 100 basis points. So the 1 point, that's 100. The 0.0, that's where the tens are. And then you have the single digits, and then you have the decimals. So going from 8 to 1, that's 7 basis points. 7.8 basis points. So what you would say in your paper is, if this is what happens next Friday, now what did it do? Interest rates fell, right? They went from 1.8 to 1.1. So we would say the 10-year Treasury rallied today as the 10-year yield fell 7.8 basis points. All right. All right, I'm going to call on someone, unless we have a volunteer. Any volunteers to do March 4th? I'll tell you what, I hear a volunteer?
I can do it.
Okay, who's this?
Reed.
Okay, Reed, go for it.
So it fell 1.8 basis points.
Okay, perfect, you got it. All right, so I'll do it with a longer sentence. Fill in the 10-year Treasury blanked today as the 10-year Treasury blank fell 1.8 basis points. Can you do
So the
the
10-year Treasury sold off today as the 10-year, or what is it, the interest rate?
yield?
The yield. As the 10-year bond yield is down 1.8 basis points.
Oh, you're almost perfect. Anybody know what's the one? Let me tell you what you said. You said the 10-year Treasury sold off today as yields fell 1.8 basis points. There's only one thing you need to fix in that.
Should be rallied.
Rallied. Yeah,
Rallied.
good job, Reed. I've done this several semesters. You're the first one to get it that close the first try. Very, very good. Now, who just said rallied there?
Brooke.
Brooke, do you want to try March 5th? Sounds like you're getting this.
Sure. Let me do some quick math.
Yeah, you got a tougher one to calculate. But good job, Reed. That was very good.
You said March 5th, right?
Yeah, March 5th. This one right here. And while she's working on that, I don't know if we have another volunteer. Let me see.
So I got the 10-year bond rallied today as the 10-year bond yield is up 6.6 basis points. Or down, I mean, up.
Okay, and so, and you probably want to use the word rose or fell. I don't know why we've picked those words.
Okay.
Rose or fell, but yeah, the 10-year Treasury yield fell. How many was it, Brooke?
6.6.
6.6 basis points. All right. March 6th. Let's see. Chris, you want to try March 6th? Chris Areola? You get one pass in the class. If you say, I take my pass, that's fine, but
Which month or which
March
day?
6th. March 6th.
The 10-year bond, Treasury, where is it? Fell. Shoot, hold on. I gotta do now.
All right, you might want to jump in. So start off, let me give you the sentence again. Let me tell you what I did on March 3rd. The 10-year Treasury rallied slightly. This 10-year bond price was up as the 10-year Treasury yield fell 7.8 basis points. All right, so the first thing you say is, are interest rates going up or down on March 6th? What did they do? Did they rise or fall interest rates?
They fell.
They fell, so that means the bond did what? Rallied or sold off?
Sold off.
No, rallied. All right, so get
Oh,
used to
rallied.
that. When rates fall, bonds rally, and then you have to do the math. So the math is a little tough. So it's 22, right? 22 basis points. So you want to try it, Chris, or someone? Anybody want to jump in?
The 10-year bond rallied up. It's a number that they lose, right? Or that it fell.
Yeah. How many basis points did it fall?
22 basis points.
All right. Got it.
Some
Let's do one more. We bound to have a volunteer by now. Sophia, you talk basis points. You want to try March 12th? Make sure you go off mute before you do it.
Okay, March 12th. It sold off 2.9 basis points.
Right. That's correct. But on your paper, and especially in interviews, use all the words. So the 10-year Treasury bond sold off as the 10-year Treasury bond yield rose 2.9. All right. Y'all have that in your notes now. All right. You're talking about the bond price. Now, I've had some students say the U.S. 10-year Treasury sold off today and yields were up, as if they're two different things. Like, wow, both the bond was down and yields were up. No, this is a mathematical relationship. If the yields are up, the bond is down. So you don't want to say and, you want to say as. They go together. The 10-year Treasury bond sold off today as yields rose 2.9 basis points. So I've had students say, yeah, 10-year treasuries are down, and also in addition to that, the yields were down, or yields were up. And it doesn't make sense. People are going to look at you funny in an interview. All right, so always know those two are related. Yields are down, the bond price is up. Yields are up, the bond price is down. Okay, so practice that. We'll definitely be practicing that in a Zoom session in smaller groups as we're getting ready for your paper one. This is the thing students miss the most. The reason I like you to get really good at this is that I've been doing this for years, and I've discovered most undergraduate finance students can't do what we just did there. That means if you go into an interview, just imagine you go into an interview and they say, hey, what did you think about that report? Say, yeah, man, Treasury sold off today. Interest rates are up a good 10 basis points. They just hired you. You just got a job just based on doing that. All right. So that's the 10-year Treasury. Practice that. So that's what we can see today. The 10-year Treasury is down today. That's what you can see why I do not like the green. The green implies good, but actually the 10-year bond market is selling off a little bit today. Now, is 4.6 a big number or a small number? So let me show you something here. This will be the last thing we'll do. But I'm going to show you something really exciting here. So what I did is I brought in the 10-year Treasury back to 1962. I won't ask how many of you think I was alive January 1962. I'll just tell you, I was not alive January 1962. I was alive January 1963. So that's almost my entire lifetime. Interest rates back then were in the 4% range or so. Today, as of yesterday, it was 0.69. All right. Anybody want to guess the max? The highest our 10 years been? It was when I was in college. Double digits. 15%. I remember when I graduated from college, I had a CD and it was rolling over, and my banks, I said, no, I'll just take my money. And they say, we got a rate 15% we can get for you. And it's 15%. I don't want 15%. Man, I can do better than that. Would y'all take a 15% certificate of deposit today? Probably would. And we know what the min is, right? We already seen that. And that was back, and that min is actually back much further than that. So 0.5% is the min. But what you need to do, and I would write this down for the paper, is the standard deviation. So you've taken statistics. I'm not going to do the standard deviation on the rate. I'm going to do the standard deviation on the change in the rate. So we know the average. Well, let's do the average of the S&P 500. It's 606%. Can you believe that? We're not even 1% today. But let's do the standard deviation. Well, let's do the average of the change. So the average of the change is obviously going to be a negative number because we started at 4%. We're at, close to zero now. So it's obviously going down, but it's a really small number. But the more important number is the standard deviation. And this is the number you should write down. And the way I state it is, when should you gasp as a finance major? When should you be shocked? And the reason I say that, if you're walking into an interview and the market is at an extreme level and you don't know it, you're going to embarrass yourself. So I'm going to tell you right now something 99% of finance majors don't know, and that is the standard deviation of the 10-year Treasury yield change is 6.5. So if you wake up one morning and you need to go to a job interview and you notice that the 10-year Treasury is up 10 basis points or down 10 basis points, you know that's a big day because that's more than one standard deviation. All right. I don't use 6.5. I use 7 as my target. Anytime you see the market move more than 7 basis points, that's a big day. So today was, I think the day is actually moved around a little bit more. I think the 10-year Treasury actually sold off more by the end of the day. Yeah, it's actually close to 6 basis points different now. So we're actually pretty close to a big day today on the Treasury. It's selling off pretty well. However, go back to March and I'll show you some amazing numbers this year. Just absolutely crazy numbers. Look at that. There's a 9. Look at look at February 28th. The S&P 500 fell 17 basis points. Now, is that a rally or is that a sell-off? Anybody know?
Rally.
And what kind of rally? Huge, right? The S&P was probably up, I can do this in my head. Probably up probably up 1.5%, 2% that day. You will notice if the stock market's up 1 or 2%, but we don't notice treasuries that much. Look at that. 10-year treasury fell 22 basis points. Let me see what the min of the entire period is. What's the lowest we've ever had? 75 is the lowest we've ever had. But that was probably back in the 80s when interest rates were 18, 19%. There's another 22. Look at this 1 week. 3 days in a row. The 10-year treasury yield fell 15 basis points. 22 right before. It was up 27 2 days in a row. This was a crazy year. So the reason I tell you this, what if you were interviewing for a job on March 24th and you had no clue this had just happened? They're not going to hire you. They won't even talk to you. The first thing they're going to say is, what do you think about the bond market? And what are you going to do? Say, oh, bond market, yeah, that was interesting. Right, what did you think? All right, you're going to try to cover. But what do you want to say? Say, yeah, I can't believe how volatile the yield on a 10-year treasury. My word, the last 3 days it's been down more than 15 basis points. The yield's been down 15 basis points or more 3 days in a row. It's just crazy. They're going to hire you. This is the kind of stuff they're looking for from finance majors. So when you do paper one, go further and explore some of these things. You can see how easy it was for me to bring all this is. I got this data from Yahoo Finance. One thing I had to do is Yahoo Finance brings in the holidays, so you have to sort it and get rid of the holidays and resort it. But you can certainly see if there's a big day. So if next Friday, if the yield falls 3 basis points, bonds rallied a little bit, but it's not a big deal. If yields go up 20 basis points, that's going to be a lot to talk about. You're going to want to find articles. Why did that happen? Did the Federal Reserve say something? All right. So you get in the picture here, right? What you're working with. And this is the other thing I strongly recommend students do is get some history of these numbers, especially the most important numbers. Where is the 10-year treasury normally? So it's average 6%, but you can also do the median. The median is very different than the average because of the 1970s. So you'll see that the median's lower. But what is the median? 50% of the time it's been below 6%, but it's still a much higher number than what we're seeing today. What if we go back to these normal levels of 4 or 5%? Well, our government would be bankrupt. The interest on the government debt of $26 trillion, the only reason our government is not bankrupt right now is because interest rates are so low. The debt interest is like, I don't know, $300–400 billion. Think about interest rates at 4%. You take that number and you quadruple it. We're paying $1.6 trillion just on interest expense. Our government's, we're bankrupt. So these are important numbers to understand and make sure you have some background on them. All right. Any questions on that? So what about the S&P 500? When do you gasp on the S&P 500? Anybody want to guess a 1% day for the S&P 500? So today the S&P is up 0.2%. I think it's probably more than that actually now. It's probably gotten to, let's see, it's about 4, oh no, it's about 0.2% today. Does that sound like, wow, going to interview, man, I can't believe what the S&P 500 did today. They're going to look at you a little funny, right? 0.2% doesn't sound all that big. So 0.2%, I'll tell you the one standard deviation on the S&P 500 is right at 1%. It's real easy to remember. So if the S&P moves less than 1%, that's not all that big of a deal. If it moves more than 1%, that's a big deal. This year, it is absolutely crazy what we've seen this year. Let me see. We have a couple of minutes here. I want to show y'all something just real quickly. I'm going to bring the S&P 500 in, and I want to show you what we've done this year. Just in case you interview on a day like this, I want to make sure you're aware of what's going on this year, so that you can somewhat talk to it. All right, just a second. My machine's really slow anytime I'm on Zoom for some reason. And all I'm doing is I'm bringing the S&P 500 in. I'm not real sure what screen you're actually seeing, but I'm back on Yahoo, but you don't really need to see it. So I'm going to bring the S&P 500 in. And let me, I don't think that's what I'm sharing, is it? Let me share the Excel here for you. Now, what I just did, I now have the S&P 500 daily back to 1927. You want to talk about productivity in the United States? This would have taken me probably 50 years to do if I had done it when I was in college. So you have a huge advantage. So let's look at the S&P 500 on a daily basis, and let's just look at its return on a daily basis. So let me do the standard deviation. It's a little bit more than 1%. That 1% I gave you didn't have the Great Depression in it. I only went back to the 60s. If you include the Great Depression, you get 1.2%, but I would just use 1%. But let's look at this market this year. And you're going to see some absolutely crazy, crazy numbers. There's a 4% day. A 4% day, that's 4 standard deviations. How often do you get a 4 standard deviation event? Once in a few billion years. Look at that. That's a 9% day. That's a 9 sigma event. Anybody remember from your stats class what a 9 sigma event is? That would be if you took 1 trillion years and raised it to 1 trillion years, you might see it maybe once. It's impossible. It cannot happen. So what happened on March 12th is impossible. And then guess what happened on March 13th? Impossible. And then guess what happened on March 16th? We had 3 days that, according to statistics, if the S&P 500 is normally distributed, those 3 days should not have happened. They were impossible. What would happen if you were interviewing on March 16th and you had no idea this was going on? They're probably not going to interview you, right? They're probably all having heart attacks and strokes. And they're probably all passed out. And you're like, what's going on? And you're like, the market. Oh, the market's, yeah, I like investing. No, you got to know what's going on. So and this period right here is actually the most volatile period we've ever seen in the history of the S&P 500, ever, including the Great Depression. Absolute insanity. I was actually buying stocks back during this time. I'd sold out before that, and I was like getting back in, so I was actually really happy. But it was very volatile, right? It's kind of a messy year, and it settled down after that. But yeah, that period of time right in here. I'm hoping next Friday we get some days like this, so you have something exciting to write about, right? You want a really exciting report, so we'll see. So that's what I say. Give yourself some historical context. Know what markets normally do. Know when to gasp. Know when to be shocked by what's going on, so you can write a good paper. All right, so that's paper 1. Do some reading. Do some research. Get ready for it. You don't have much else to do with this class other than to watch the videos of the class and get ready for paper 1. And next Friday, then you can really get into it. All right. Any questions? Any final questions on any of this?
Where can we access your videos on YouTube?
Yeah, I'll give a link tomorrow. I send out an email every Friday, and I'll give you a link to my. I have it in a playlist, so I do have it organized. I'll have this class out there as well. I'll convert it. So yeah, you'll get that in my weekly email.
Okay, thank you.
Any questions on the paper? Can y'all do this?
I'm gonna need some help with that, with the Treasury
The basic points?
phrasing again.
So what I recommend you do is next Friday, write your phrase down and then call me. I'll be on my bike. Call me and read it to me, and I'll let you know if you got it right. I'll let you know if I'm going to hire you for the job or not, based on what you say. All right. You do need to get good at basis points. It is used a lot, especially if you interview at JP Morgan. It's not that they're not looking to see if you know how to use basis points. They're assuming you do. They assume all finance students. They talk this all day long. They don't remember that in college we didn't use basis points. They use it so much they're absolutely shocked that students don't know this. So this doesn't separate you from the competition. This just lets you keep continuing on. But if you say in a really sophisticated way, that will separate you. So just knowing what basic points are is not nearly as great as walking in and saying, man, you see the Treasury market today, man, down 4 basis points, man, or down 15 basis points, really rallying. you say it in an intelligent way, that will get you jobs, because that does not sound like an undergraduate student. Anything else on paper one? I'm hoping for great, great papers. I hope y'all blow me away. So there are example papers out there. And so I do not want you copying the example papers, but do look at them for ideas for the formatting, especially. I do like the formatting that they use in those papers. So I've been debating whether or not to put the example papers out there or not, but I'll put at least one of them out there for the formatting. But I've had students take those example papers and copy and paste them and then just edit it for this report. And boy, that is, I hate that. I'll take off 99% if you do that, plus or minus. So don't do that, right? Is that enough encouragement not to do that? Do not copy and paste if I give you an example paper. Start from scratch with your own paper. Anything else? All right. I'll stick around if anyone wants to talk, but otherwise I don't know when I'll see y'all again. Hopefully y'all will call me and talk careers or talk employment reports or whatever. So, you know, give me a call and introduce yourself to me sometime here in this next couple of weeks so I know who you are. Call, I'm seeing you now as I'm into eyeballs.